Let's go through an example of putting together the statement of cash flows using the income statement, the balance sheet, and a series of notes. We need the notes because we cannot get all of the information just from the other financial statements. You need to dig into some of the details of the records to find out what was cash, what was not, and so on, especially for the investing and the financing sections. So the notes in your homework problems are essential to completing the problem. And I have the income statement right here, balance sheet over here, and a series of notes. Well, let's go through these notes and then we'll figure out later where these fit in. So we received cash on a loan from the bank, $30,000. We paid back loans to the bank of $40,000. We sold equipment for $18,000 and then purchased new equipment for $50,000. The equipment that we sold had a cost of $20,000 and accumulated depreciation of $10,000. We issued stock for $30,000. Now, if you're used to sole proprietorship, that's like an owner contribution. The change in retained earnings is due solely to net income and dividends. And we'll look at the formula that we need to fill in the blank to figure out how much we're paid in dividends. Again, if you're used to the sole proprietorship terminology, dividends are the same thing as drawings. All right, so let's start out. At the top of a statement of cash flows, you are going to have statement of cash flows. And then you will put below that probably the company name. In this case, it's Dunder Mifflin. Or we could flip those around. Let's make it match the other ones. All right. And then you can see on the financial statements, the terminology for the date is important. Income statements are for a period of time, so the date phrase needs to cover a period of time. This one is for the year ended December 31st. And the balance sheet is a point in time, so it's as of a certain date. So in this one, it's as of December 31st. A statement of cash flows shows the change in cash over a period of time, so it's going to match the terminology from the income statement. So it's going to be for the year ended. It's going to match whatever we had on the income statement. All right, now we're going to start with the operating section. Or we could more specifically say cash flows from operating activities. And we start with the net income. In this case, it's going to be the $60,000 of net income. Let's make this look a little bit nicer. And then we could have a title for like adjustments for non-cash items. Sometimes it's just going to go right into the adjustments, but I like specifying that these are adjustments for non-cash items. In this case, the non-cash item that we're most concerned about is depreciation. Depreciation expense is never a cash expense. So we are going to adjust our net income for the depreciation expense. We will add back the $25,000. As we stated in a previous video, this is as if we crossed out the depreciation expense line on the income statement and said, what would the net income be if depreciation wasn't on here? The other adjustment that we have to make, and it's usually grouped in with non-cash items, even though it's not really a non-cash item, are the gains and losses. These are really non-operating items and don't belong in the operating section. So again, we have to pretend we cross those ones out and what would happen to the net income if they didn't exist. So we're looking at the gain on sale of equipment. Sales of equipment belong in the investing section, not the operating section. So we need to adjust for the gain on sale of equipment. And since if we crossed out that $8,000, what would happen to our net income? It would go down. So we have to subtract the $8,000. All right, now we have adjustments for changes in current assets and current liabilities. And you could see different labels for this as well. Sometimes you just see adjustments or changes in operating assets, changes in operating liabilities. Again, the subtitles aren't all that important, exactly how you word them. You just have to convey what they mean. All right, so we'll say adjustments for changes in current assets and current liabilities. And now we're going to go through all of our current assets and liabilities, except for cash, and say, all right, did they go up or did they go down? Let's start with accounts receivable. All right, with accounts receivable, we started with 40,000 and it went up to 48. As we saw in a different video, what that means is we received the 48,000 during this year. It was not included in the net income. And then we did not receive the 48. It was included in the net income, but we didn't actually get cash. So we end up adding the 40, subtracting the 48. If a current asset goes up, we have to subtract it. So this one went up by 8,000, so we have to subtract the 8,000. And we do the same for all of the other current assets. We also do this for inventory. Inventory went down 8,000, so we have to add the 8,000 for the change in inventory. Prepaid insurance is the last current asset. That one went down 2,000 from 6,000 to 4. So we add the $2,000 difference. Now we're going to go to the current liabilities. We have accounts payable. And this one is the opposite of our current assets. So with accounts payable, the $30,000 at the beginning was not included in the net income. So usually these represent expenses. And the expense was not included in the $60,000 net income, but we did pay that $30,000 from the beginning of the year. So we have to subtract the 30, but then add the 35. So why do we add the 35? The 35 represented expenses that were subtracted to get to the net income, but we didn't actually pay them. So it is being subtracted to get to the 60. It's probably somewhere over here in the other operating expenses. It's part of that 48, but we didn't actually pay it. So we need to add that $35,000 back because it represents expenses that we did not pay. All right, so we subtract the 30, add the 35, which ends up with a net of $5,000. So with current liabilities, if they go up during the year, that means we have to add it in our operating section. And if they go down during the year, that represents cash that we paid. And so wages payable, we have wages expense over here of $95,000, but we actually ended up paying a net of $3,000 more than what's actually on our income statement. So if current liabilities go down, that means we paid extra. So we paid $3,000 extra over what was on the income statement. And finally, income tax payable is our last current liability. And that one went up $2,000. So we add $2,000 as an adjustment in our operating section. All right. So usually at this point, we'd also have another subtotal for total adjustments. I'm just going to skip right to the cash either used by or provided by operating activities. And the terminology depends on do we have a positive or negative cash flow? So let's add all of this together. Have $60,000 in net income, which is close to our cash, but let's make a few adjustments to get it to a real cash number. We used all of our clues like non-cash items, non-operating items, and then just using our balance sheet to figure out how much cash did we pay or get in addition to what was on the income statement. So we have $83,000 in cash provided by operating activities. Again, the wording can change a little bit from company to company, statement to statement, but the wording usually is something like this, where it's provided by or cash used by that certain activity. All right, let's move on to the next section, and this would be cash flows from investing activities. Usually, these are just the property, plant, and equipment. It can include stocks and bonds and things that we invested in, like in other companies, but usually it's investing in ourselves, like buying buildings or buying equipment for future operations. And the operating section uses the indirect method. And we've covered the differences in a different video, but the investing and financing sections always use the direct method. And the indirect method, we can get basically all of the information from the income statement and balance sheet. We don't really need to go beyond that. And we did say the direct method, we need more steps. And that means looking at more details. And that's what we need to do for the investing activities. We can't just look at, well, looks like our equipment went up $30,000. Well, that could be because we bought and sold stuff, which is what happened here. We purchased equipment for $50,000, but sold equipment for $18,000. We have to put those on separate lines. We can't get that information just from the balance sheet. It doesn't give us everything. So we have to dig down into the records and find out what actually happened. We have to put these on separate lines. So let's say that we purchased equipment. We'll have to look into in the notes of the homework problem to find out how much it actually was. And we purchased it for $50,000. And that's a negative since it is a cash outflow. At this point, I would caution you to be careful. Remember, this is the statement of cash flows. Often, businesses buy equipment with loans, which is not cash. So if we had purchased this equipment with a loan, we would not put it here because it's not cash. So just be careful that you're only putting cash transactions here. All right, the other one is we sold equipment for $18,000. And we can use some fancy wording here, like proceeds from sale of equipment. That's often the wording that is used. And we got $18,000. I want to point out this has nothing to do with gains or losses or what the equipment originally cost us. We'll look at that just a little bit here. It's the actual cash that we got. So if you're looking at the cost of equipment on the balance sheet, we had $250,000 and then we purchased equipment of 50,000. So you'd say, well, that went up to 300,000. And then we sold the equipment and it went down to 280. That's $20,000. But I only put 18,000 here. That's because the equipment sold had an original cost of $20,000, accumulated depreciation of 10,000. If you were doing a journal entry, we would say we got cash of 18,000. We have to get rid of the equipment, which originally cost us 20,000. We have to get rid of the associated accumulated depreciation, which was 10,000. And that leaves us with a gain of $8,000. And that gain showed up on the income statement. So just be careful here. The gain was subtracted out of the operating section, not because we got that cash or we gave up that cash, but because it was not an operating item. And in the investing section, just be careful that you only put the amount of cash that we got from the sale. You might be able to calculate the amount of cash if all you know is the gain and the original cost and the accumulated depreciation. It's just like trying to fill in the blank in a journal entry. So you may or may not be given the actual cash amount, especially if you're doing a much harder problem. It will just tell you, this is what the equipment originally cost. This was the accumulated depreciation. Calculate the cash. And so you might have to piece it together. All right, those are the only two investing activities that we have over here. So let's go ahead and add these up. We spent a net of $32,000 on investing activities. So this would be a cash used by investing activities. Other language you might see there is net cash used by investing activities. Sometimes you see net cash instead of just cash, but again, terminology can be a little different from company to company. All right, last section is cash flows from financing activities. And just like the investing section, this uses the direct method, which means we can't just use the financial statements to put this together. We'll have to go into the details of accounts to find out what were the actual cash transactions here. And in homework problems that you're doing, they're probably going to be given in notes. And I'll caution you again, be careful that you're only doing the cash transactions if they do not involve cash. For example, we get a loan from the bank and it's for this equipment. So it was equipment for a loan, no cash involved. It's not included in the investing or the financing section. In this case, we're saying we received a loan from the bank for cash, $30,000. We can say proceeds from loan. And we got $30,000 of cash, so that will be a positive. Then we also paid back the loans from the bank. We could just say loan payments. And this is a negative $40,000 because that's a cash outflow. We cannot net these two together. You see here on the balance sheet, the notes payable went from 70,000 down to 60,000. That's a net of 10,000. You could say we paid back $10,000 worth of loans. But using the direct method, we cannot just net those two things together. We have to separate them into what did we get from the bank and what did we pay back to the bank. And again, we can't just get that info from the balance sheet. We're going to have to go into the details of the account to see what happened. All right. Moving on to the other source of financing that companies have, the owners. Did we get any cash from the owners or new investors? And indeed we did. In this one, we issued stock for $30,000 of cash. If you're used to sole proprietor language, that's like the owner contributions. So we got $30,000 of cash from the owners. We'll say issued common stock. We got $30,000. And then finally, we ask, did we give any money back to the owners? In a sole proprietorship, that would be called drawings. In a corporation, it's called dividends. Now, we were not given the exact amount of dividends here. So at least in the notes, but we can calculate it. And I purposely did not put the amount of dividends so we could get some practice calculating the amount of dividends. All right, and the retained earnings formula is very similar to the owner's equity formula in a sole proprietorship. We start with beginning retained earnings. Which I'm just putting the calculation over here temporarily. Beginning retained earnings was $111,000. And then you add the net income. Which was $60,000. We just get that from the income statement. And then you subtract the dividends. Again, that's the same thing as drawings. That's the part we don't know. And that gets us to ending retained earnings, which we get from the balance sheet, and that's $145,000. Now it just becomes a game of fill in the blank. So we have $111,000 plus $60,000 is $171,000. What do we have to subtract to get to $145,000? And so we need to subtract, I think it's $26,000. And I'm just going to double check my math there. Indeed, the 26,000 is the correct number to get us from 111 plus 60 minus 26 to get us to 145. All right, so now we calculated the amount that we gave back to the owners. I'm going to move this somewhere else on my spreadsheet. And just say dividends paid, or if we're doing a sole proprietorship, you can say drawings. And we paid out $26,000 to our investors or the owners. All right, this gets us down to the cash either provided by or used by financing activities. And it's a negative $6,000. So this is cash used by financing activities. All right, so we have our three sections done now. Let's just finish off the statement of cash flows. The first thing that we do is we add all of those subtotals together. It might be, the title of this line might be net change in cash, or cash increased or decreased during the year. I'll say net change in cash, and we're just going to add those three subtotals together. So our net change was $45,000. It went up. And then we say, what was our cash at the beginning of the year? So it might say beginning cash, it might say cash on January 1st, or it might say cash December 31st, 2020, whatever last year's was. And in this case, we get that from the balance sheet, and that was $47,000. And if we add those two together, we had 47 at the beginning of the year. We added a total of 45,000. That gets us 92,000. That should be our cash on December 31st. If we did it right, the 92,000 should match what is on our balance sheet for ending cash. And indeed, it does match. We have this 92,000 over here. That should match the ending number on your statement of cash flows. If you don't get that number, you did something wrong. Either you added or subtracted something that you shouldn't have, or maybe you had the sign wrong, like you added something when you're supposed to subtract it, or something like that. All right, last thing to mention here is when we're talking about non-cash transactions. Up here in the 3 sections, we only put cash transactions. If we purchased equipment with a loan, that would not show up anywhere in those 3 sections because it wasn't cash. But it is important for investors to know that you made this big transaction. You purchased a lot of equipment with a loan. They want to know that, even though it doesn't show up on the statement of cash flows. So to give investors more information, we have to also add a table down at the bottom that says significant non-cash transactions. It has slightly different names, but with that flavor. So significant non-cash transactions. And depending on which homework platform you're using or whatever, this might look a little different. What we usually did is we would just write a description like purchased equipment with a loan, and then we might put an amount, $50,000, just as an example, where we said, all right, we purchased $50,000 of equipment with a loan. It didn't involve any cash. Again, all we're putting down there are the things that we might think investors would want to know, these significant non-cash things. That's generally speaking when we're purchasing property, plant, and equipment with loans. That's the most common transaction that you would see. All right. I hope this helped you visualize how we put together the statement of cash flows. So just remember the 3. First of all, the date. It matches the income statement date. It's for a period of time, so make sure the language of the date line is for a period of time. We have the operating activity section, which uses the indirect method. The only thing that really has meaning to an investor is that last number. All of these things are just adjustments to get net income to a real cash number. We have our investing and financing sections, which use the direct method, which means we have to look at details to find out separate our what did we spend versus what did we get for sales. And we can see examples of that with purchasing and selling equipment, getting loans and paying back loans, and getting money from investors and paying back those investors. The very end is we have the net change in cash, just a total of how much did it change, those 3 subtotals. What did we have at the beginning of the year to calculate what we had at the end of the year, and make sure that matches what we have on the balance sheet for the end of the year cash.